What you want to do is use your notes on the federal income tax that I have posted in Module 4, Lesson 1, and follow along as I go through this example. So now let's learn how to compute the tax and taxable income for income tax, or for an individual's income tax. Carl has gathered his annual finance data for 2012. His salary was $120,000. His taxable interest received was $1,800. His total itemized deductions was $6,500. His personal exemptions fell to $3,800. And his standard deduction was $5,950. Okay? So what we have here is a formula for figuring out his taxable income. And you'll notice I have a note here that basically says use the itemized deduction if it's greater than the standard deduction. Okay? So we have the salary plus taxable interest minus itemized deduction minus personal exemptions. Okay? Or salary plus taxable interest minus the standard deduction minus personal exemptions. Okay? So since Carl's itemized deduction is greater than his standard deduction, we're going to use the itemized deduction. So now plugging in the numbers, you can see we have the 120 plus the 1,800 minus the 6,500 minus 3,800, which is his personal exemption. Okay? And so therefore, when we plug in the numbers and do the calculation, Carl's taxable income comes to $111,500. Okay? Now, in this next example, we're going to use figure 9.2 from the Mike Sale textbook. And my book is on page 410 to help us figure out the tax rate for Carl. Okay, so Carl is single with a taxable income of $111,500. Okay, so therefore, using the federal rate schedule as outlined in figure 9.9-2, his tax rate is $17,025 plus 28% of the amount above $83,600. Okay, in this case, 28% is the marginal tax rate. So in other words, what that basically means is that 28% of his income above $83,000 will be taxed. And if you weren't aware of this, then you should be reading chapter 9 of the textbook. Your income is not taxed at the same rate. Okay, so therefore, the lower portion of your income is taxed at a different rate than your higher portion. All right. So now looking at our formula here, we have his tax equals the $17,000 plus the 28% times the $111,500 minus $83,600. Okay, it's simple enough. So therefore, Carl's tax is $24,837. All right, so that's how much Carl is supposed to pay in taxes. Okay, now another example says to figure out his average tax rate. Now, a moment ago, I told you that your taxes that you pay, or rather your tax rate, changes across the spectrum of your income. So therefore, we have to come up with an average tax rate across your whole income, right? So since we know that Carl's tax, right, that he's paying is $24,837, we're basically going to divide that by $111,500 to come up with an average tax rate across the whole spectrum of his income. So when we do that, his average tax rate comes to 0.222 or 22.2%. So in other words, on average, 22.2% of Carl's income is being taxed. Now our last example here says that an omission was found regarding his personal deduction, okay, in the amount of $700. So given that, right, we have to correct that. So how much does his tax liability fall? Well, that's simple enough, because what we're doing basically is saying that, you know what, of that $111,500, we need to reduce that amount, his taxable amount, by $700. All right. So if you recall the formula for that, was the 17,025 plus the 28% times whatever was over the $83,600. Okay, so what you could do, you could go back and do that formula again and just subtract $700 from the $111,500, or you can just simply multiply 28% times the 700, and his tax liability would fall by $196. Now, one last example here at the bottom of my screen, or of your slide rather. After discovering the $700 omission, we discover a $270 credit omitted from the calculations. How much does his tax liability fall? Well, since it's a credit, it's going to be a straight $270.